The amateur speculator confuses volatility with opportunity. He sees wide, swinging markets and thinks of the great profits to be made in a single day. The professional sees the very same conditions and thinks only of the great risks. A volatile market is not a playground. It is a battlefield where the slightest misstep results in catastrophic loss. It is a siren whose beautiful song of quick riches lures the unsuspecting onto the rocks of financial ruin. Your job is not to chase the song, but to recognize it as a warning, to reduce your sail and to navigate with extreme caution. To believe you can capture these violent swings with a heavy line of stock is the height of arrogance, and arrogance the market always and without fail punishes. I learned this lesson not in a placid, orderly market, but in the crucible of chaos. The most instructive events are not the easy victories, but the moments of extreme danger where survival itself is the only victory that matters. Consider the San Francisco earthquake of 1906. Before this event, I had, through my analysis of market conditions, concluded that the bull run was overextended and that a break was imminent. I was heavily short the market, including a significant position in Union Pacific. When the news of the earthquake broke, it was an act of God, an unforeseen catastrophe that would surely send prices tumbling. My brokers were ecstatic for me. They saw a windfall, a quick and massive profit handed to me by fate. They expected me to press my advantage, to short even more stock into the panic that was sure to ensue. They saw only the opportunity. I saw only the danger. A market reacting to a known business factor is one thing. A market reacting to a calamity is another entirely. It ceases to be a place of calculated speculation and becomes a theater of raw, primal emotion. It becomes disorderly. In a disorderly market, there are no rules. Precedent is useless. The tape, the modern equivalent of which is the live streaming feed of prices and volume, no longer tells a coherent story of supply and demand. It screams a tale of pure fear. To trade a heavy line in such an environment is to wager your entire stake on the whims of a stampeding herd. Therefore, against all the advice and expectations of those around me, I gave one simple order to my broker for the opening: buy to cover my shorts. I did not seek to wring every last point out of the drop. I sought to do one thing and one thing only: turn my paper profit into real cash and get out of the path of the storm. The first loss is the best loss, and the first priority is always capital preservation. That morning I made a great deal of money, not by being aggressive, but by being defensive. I turned volatility into safety by liquidating my position entirely. The greatest profits are often those you secure by refusing to take unnecessary risks. My life was a series of such lessons, each one paid for in full, either with my own capital or my own peace of mind. A speculator without an understanding of history is like a doctor without knowledge of anatomy. He is destined to repeat the mistakes of his predecessors because he never bothered to study their scars. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. The principle of reducing exposure in the face of uncertainty extends beyond singular catastrophic events. It applies with equal force to the very nature of market cycles. The end of a great bull market is always characterized by wild and feverish activity. Stocks that had been advancing by points now begin to leap by tens of points per day. The public, which had been cautious for months, now throws all restraint to the wind. The newspapers and brokerage boardrooms are filled with stories of instant millionaires. This is the final intoxicating phase. It is also the most dangerous. The volatility is extreme. The gains seem effortless. It feels like a new era where the old rules of prudence no longer apply. This is precisely the moment when the wise speculator begins to sell. He does not wait for the top. Trying to catch the absolute peak is a fool's errand. Instead, he sells into the strength, into the wild buying of the euphoric crowd. He reduces his line, taking profits off the table piece by piece. He is turning the market's terminal volatility into the safety of cash in his bank account. While the amateur is leveraging up for one last glorious ride, the professional is quietly heading for the exit. He knows that in a market that has gone vertical, the risk of a sudden, sharp reversal outweighs the potential for a few more points of profit. Survival is the game, and you do not survive by being the last one to leave a party that has gotten out of control. This brings me to a tool of risk management that is not found on any chart or in any mathematical formula. It is found within you. I speak of the sleeping point. There were times in my career when I held a line of stock so large that I could not sleep. I would lie awake at night, my mind racing, replaying the day's tape, agonizing over every tick. This was not a sign of my dedication. It was a blaring alarm bell, a physiological signal that I had exceeded my emotional limit of risk. The market's external volatility had created an unbearable internal volatility. The cure was simple and immediate. Sell down to the sleeping point. If I had 100,000 shares and could not sleep, I would sell until I reached a level, perhaps 50,000 or 20,000, where the potential loss no longer disturbed my peace. A speculator cannot think clearly when he is consumed by anxiety. Fear and greed are his two greatest enemies, and an oversized position in a volatile market feeds them both. Your mind is your greatest asset. If you lose your mental equilibrium, you will lose your money. Therefore, the rule is absolute. If you cannot sleep because of a position, your position is too large. It does not matter what your analysis says or what your profit target is. You sell down to the point of comfort. You turn the volatility that is causing you distress into the safety of a manageable position and a clear mind. Of course, the most powerful lessons are often learned not from success but from failure. My greatest blunders came when I violated this very principle, when I allowed my ego and a stubborn opinion to override the clear warnings the market was giving me. I recall a time in the cotton market when I was convinced a bull move was underway. I had my reasons, they were sound, and I established a large position. But the market did not behave as it should have. It became erratic. It would rally one day and break sharply the next. It was volatile and choppy, refusing to follow the line of least resistance upward. The tape was telling me that something was wrong, that a powerful force was selling into every advance. Instead of heeding this warning and reducing my line, I held on. I listened to another man, a supposed cotton expert, who assured me my thesis was correct. I substituted his opinion for the market's facts. My position was too large for the volatile conditions, and my stubbornness was absolute. The result was a devastating loss that cost me millions and set me back years. The mistake was not in being wrong. Every speculator is wrong from time to time. The mistake was in staying wrong, with a full line of stock in a market that was screaming a warning through its volatile, contradictory action. I did not reef the sail in the storm. I held my course, convinced of my own navigational genius, and the market broke my mast. A choppy, volatile market that is not acting in accordance with your thesis is a direct command from the tape itself to cut your position size immediately. It is telling you that the game has changed, that visibility is low, and that you are in danger. To ignore that message is to commit financial self-destruction. From these experiences, the triumphs of caution and the disasters of arrogance, a clear strategy emerges for handling volatile markets. It is not a complex algorithm, but a simple, robust system of self-preservation. First, you must correctly diagnose the character of the market. You must ask yourself, is this an orderly trend or a disorderly, chaotic environment? An orderly market moves with purpose. Its reactions are shallow and on low volume. It respects key levels. A volatile, disorderly market is the opposite. It is characterized by huge, nonsensical daily ranges. It gaps up and reverses, or gaps down and screams higher. News that should move it one way sends it the other. In such a market, your primary objective shifts from profit maximization to capital preservation. Second, once you have diagnosed a disorderly market, you must adjust your position sizing. This is not optional. My rule was to cut my normal trading size in half, and often by 3/4 or more. If my standard probe in a calm market was 2,000 shares, in a volatile market, it might be only 500. This accomplishes two critical things. It dramatically reduces the dollar amount at risk on any single trade, insulating your capital from the vicious whipsaws that are common in such environments. More importantly, it keeps your mind calm and objective. A small loss on a small position is merely a business expense. A large loss on a large position is an emotional body blow that clouds judgment and leads to the fatal error of revenge trading. Third, and this may seem counterintuitive, a smaller position size allows you to use a wider, more technically appropriate stop loss. In a volatile market, a tight stop is a guaranteed loss. The random noise and wide swings will take you out of a perfectly good position before it has a chance to move, but you cannot afford a wide stop with a large position size. The solution is to marry the two concepts. Trade a smaller size, which then permits you to place your stop at a logical point of invalidation, below a major support level, for instance, rather than at an arbitrary point dictated by your pain threshold. You are risking the same percentage of your capital, say 1 or 2%. But you are giving the trade the room it needs to navigate the choppy waters. You risk 1% on 500 shares with a 5-point stop, instead of risking 1% on 1,000 shares with a 2.5-point stop. The dollar risk is identical, but the probability of survival is far greater. Finally, you must be willing to embrace the safest position of all, cash. There are times when the volatility is so extreme, the uncertainty so profound, that any position, long or short, is a pure gamble. During the banking panics of 1907 or at the outset of a major war, the intelligent speculator is not in the market. He is on the sidelines, in cash, watching and waiting. He is preserving his capital and, just as crucially, his emotional energy. The desire to always be in the market is a novice's impulse, born of a need for action. The professional understands that his job is not to trade constantly, but to trade profitably. And very often the most profitable action is to do nothing at all, to wait patiently for the storm to pass and for the line of least resistance to once again become clear. Do not be the speculator who boasts of the courage to hold a large position through a storm. That is not courage, it is recklessness. True courage lies in the discipline to act against your own greed and excitement, to reduce your exposure when everyone else is doubling down. The market pays you for being right, but first you must survive. And survival in a volatile market is a direct function of your position size. The market will always be there tomorrow with new opportunities. The only question is whether you will be. Turn volatility into your servant, not your master. When the seas get rough, reduce your sail. It is the only way to ensure you live to sail another day.